Here is one of the most well-documented, frequently replicated findings in long-run market research, and it should change how you think about ever trying to time your way in and out of the stock market. If an investor had stayed fully invested in a broad market index across a multi-decade period, capturing every single trading day's return, they would have earned the full long-run market return for that period. But if that same investor had missed just the single best 10 trading days during that same multi-decade stretch, out of literally thousands of trading days, their total return would have been reduced dramatically, in many documented historical studies cutting the total accumulated return by roughly half or more, depending on the specific period studied. Missing just 10 days out of thousands cuts your returns by half, not 10% of the days, 10 individual days. This finding has been replicated across multiple decades, multiple markets, and multiple specific time periods studied by different researchers, and it points to a specific uncomfortable truth about why trying to time the market, selling before a downturn, buying back in after things feel safe again, is so much more dangerous than it intuitively seems. Here is the reason this matters so much. The single best trading days, historically, do not happen during calm, comfortable periods when it feels safe to be invested. They happen with remarkable, well-documented consistency in extremely close proximity to the single worst trading days, often within days of each other, sometimes within the very same week, during periods of maximum fear and uncertainty, precisely when an investor attempting to wait until things calm down is most likely to be sitting in cash. This video explains exactly why this clustering happens, the specific behavioral reasons investors consistently time their way out of the best days without realizing it, and the practical, evergreen alternative that does not require predicting anything at all. Let us build the specific mathematics behind the claim from the opening, using a standard, conservative, illustrative scenario consistent with widely replicated long-run market research. The illustrative scenario: assume a $100,000 investment in a broad, diversified equity index held over a 20-year period during which the index delivered a standard, conservative long-run average annual return of approximately 8% to 10%, an illustrative range consistent with long-run historical equity market performance broadly, not tied to any specific current period. Scenario A: fully invested every single trading day for the entire 20 years. The investor captures the full compounding effect of every up day and every down day across the entire period, ending with the full benefit of the index's actual long-run average return, the baseline against which every other scenario in this segment is measured. Scenario B: missing only the single best 10 trading days during the entire 20-year period. Using illustrative figures consistent with widely cited, peer-reviewed, and industry research studies that have examined this specific question across multiple major market indices and multiple multi-decade periods, an investor who missed just these 10 specific days, while remaining invested every other day across that same 20-year period, would have ended with a final portfolio value reduced by roughly 50% or more compared to Scenario A, despite having been invested for over 99.8% of all trading days during the entire period, 10 missed days out of approximately 5,000 trading days across 20 years. Scenario C: missing the single best 20 trading days during the same period. The reduction becomes even more severe, in many studies leaving the investor with a final portfolio value barely above their original starting capital, after adjusting for the powerful compounding effect those specific missed days would otherwise have contributed across the remaining years of the holding period. Why this happens, the compounding mechanism behind it. A market's single best days frequently produce returns of 5%, 8%, or even more in a single trading session. And because of how compounding works, missing a day with an exceptionally large positive return does not simply cost you that one day's gain. It costs you that gain, plus every additional year of compounded growth that gain would have generated on top of itself for the remainder of the holding period. A large gain missed in year 3 of a 20-year holding period has 17 additional years to have compounded upon itself, meaning the true cost of missing it by the end of the full period is dramatically larger than the single day's percentage return alone would suggest. The asymmetry this creates, because the very best single days produce such disproportionately large returns, and because missing them removes not just that day's gain, but also every subsequent year of compounding on that gain. The mathematical cost of missing a small handful of the very best days vastly exceeds what most investors intuitively expect, given that those days represent such a tiny fraction of the total number of trading days across any long holding period. Your action step: before considering any strategy that involves moving in and out of the market based on predictions about near-term conditions, explicitly internalize this asymmetry. The number of days that matter most to your total long-run return is a tiny handful out of thousands, and you cannot know in advance which specific days they will be. Here is the vault from the opening. The specific structural reason the single best trading days happen in close proximity to the single worst trading days, rather than during calm, comfortable periods, and why this fact alone makes market timing mathematically much harder than it intuitively seems. The phenomenon of volatility clustering. Markets exhibit a well-documented, statistically established pattern called volatility clustering. Periods of large price swings in either direction tend to occur together, in clusters, rather than being evenly and randomly distributed across calendar time. A period of unusual market turbulence is not typically a single large move, followed immediately by a return to calm. It is typically a sustained stretch of multiple large moves, both sharply negative and sharply positive, occurring in close succession, often within the same days or weeks of each other, before volatility eventually subsides back toward more typical levels. Why this happens, the underlying mechanism. During periods of significant uncertainty, a financial crisis, a major unexpected economic shock, a global event with genuinely uncertain implications, investors as a group become highly responsive to each new piece of information, reacting strongly to negative news with sharp sell-offs, and reacting just as strongly to positive or reassuring news, including signs of policy intervention, stabilizing economic data, or simply a partial reversal of excessive pessimism with sharp rallies. This back-and-forth, high-sensitivity reaction pattern during periods of uncertainty produces exactly the clustering pattern described above. Large down days and large up days occurring within the same turbulent window, rather than being separated by calm periods. A real, well-documented historical illustration of this pattern. During the 2008 global financial crisis, several of the single largest one-day percentage gains in major market indices' entire histories occurred within the same several-month window as several of the single largest one-day percentage losses in those same indices' histories, meaning an investor who sold during the depths of the crisis, intending to wait until things calm down before buying back in, was statistically very likely to miss several of the most powerful single-day rebounds of the entire multi-decade period, specifically because those rebounds occurred while conditions still looked and felt extremely uncertain, not after a clear, comfortable, all-clear signal had been given. The 2020 COVID-19 market crash and rapid recovery exhibited a similar, well-documented pattern, with several of the largest single-day percentage gains in market history occurring within weeks of the initial sharp decline, during a period when the broader economic and public health outlook remained genuinely uncertain. Why this specifically defeats the intuitive wait for clarity strategy. The natural human instinct during a market downturn is to wait until things feel safer before reinvesting. But because the data shows the best days cluster specifically within these uncertain, turbulent periods rather than after them, waiting for clarity as a strategy is, by its very structure, systematically likely to cause an investor to miss precisely the days that matter most, because by the time genuine clarity and comfort return, the majority of the recovery's most powerful single days have frequently already occurred. Your action step. The next time you feel the instinct to move to cash during a period of market turbulence specifically in order to wait for things to calm down before reinvesting, recognize explicitly that this strategy is not simply emotionally difficult to execute well. It is working directly against a well-documented structural feature of how markets actually behave during exactly these periods. If the mathematics and the structural clustering pattern covered so far are this clear and well-documented, why do so many individual investors continue to attempt market timing anyway? And why does the data show they consistently underperform as a result? The documented behavior gap. Annual investor behavior studies, most notably the long-running research published by DALBAR, which has tracked average investor returns against the broad market's actual returns over multi-decade periods, have consistently found that the average individual equity fund investor earns a meaningfully lower return than the broad market index itself over the same time periods, frequently by several percentage points annually, compounded over decades into an enormous cumulative gap. This is not primarily explained by investors picking worse-performing individual funds. It is substantially explained by the timing of when investors choose to buy and sell within those funds. Buying more aggressively after a fund has already risen significantly, and selling more aggressively after it has already fallen significantly. The psychological mechanism behind this pattern, recency bias and loss aversion working together. Recency bias causes investors to overweight recent market behavior when forming expectations about the near future. A market that has been rising recently feels safer and more attractive to invest in, and a market that has been falling recently feels riskier and less attractive, even though, mathematically, recent performance provides limited reliable information about near-term future performance, and falling prices, all else equal, mean the same underlying assets can now be purchased more cheaply. Loss aversion, the well-documented behavioral finding that the psychological pain of a loss is felt more intensely than the pleasure of an equivalent gain, causes investors to feel a strong urge to stop the bleeding during a market decline by selling, even when the rational, historically supported response, based on the asymmetric mathematics covered in Segment 1, would be to remain invested or, for an investor still in their accumulation years, to continue or even increase contributions while prices are temporarily lower. Why these two biases combine into precisely the wrong behavior at precisely the wrong moments. Together, recency bias and loss aversion produce a behavioral pattern that is, structurally, almost perfectly misaligned with the actual mathematics of long-run investing. Investors are psychologically drawn toward buying when prices, and therefore expected future returns, are relatively less attractive, and toward selling when prices, and therefore expected future returns, all else equal, are relatively more attractive, the precise opposite of buy low, sell high, driven not by irrationality in any simple sense, but by deeply ingrained, well-documented, evolutionarily understandable psychological responses that operate in essentially every individual investor to some degree. Why this is not primarily a matter of insufficient intelligence or financial education, It is worth stating explicitly, this behavior gap has been documented among populations with substantial financial sophistication, not solely among inexperienced beginner investors, because these psychological mechanisms operate below the level of purely rational, deliberate calculation, and resisting them effectively generally requires a structural, automated solution rather than relying on willpower or analytical understanding alone in the heat of an actual market downturn. A point addressed directly in the next segment. Your action step. Honestly recall your own emotional and behavioral response during the most recent significant market downturn you personally experienced as an investor, regardless of how you actually acted at the time, and use that honest recollection as a forecast of how you are likely to feel and be tempted to act during the next one, because the next downturn's emotional pull will very likely feel similarly intense, regardless of how clearly you understand the mathematics covered in this video right now. In a calm moment. If the data shows that individual market timing decisions, driven by deeply ingrained psychological responses, consistently work against an investor's own long-run interests, the practical solution is not to rely on willpower or improved analytical understanding alone in the moment. It is to structurally remove the timing decision from the process entirely. The core practical strategy: dollar cost averaging through automation. Dollar cost averaging means investing a fixed predetermined dollar amount on a fixed predetermined schedule, weekly, bi-weekly, or monthly, aligned with a paycheck. Regardless of what the market is doing on that specific day, neither accelerating contributions because the market has been rising and feels good, nor pausing contributions because the market has been falling and feels scary. Why this specifically defeats the behavioral trap covered in Segment 3. By removing the decision of when to invest from each individual moment, dollar cost averaging structurally prevents the recency bias-driven and loss aversion-driven mistiming covered in the previous segment, because there is no decision point left at which those biases can exert their influence. The contribution happens on schedule, automatically, whether the investor feels enthusiastic, fearful, confident, or anxious about market conditions on that particular day. The mechanical side benefit: buying more units when prices are lower, automatically. Because the dollar amount invested is fixed, while the price per unit of the investment fluctuates, a fixed dollar contribution automatically purchases a larger number of units when prices are lower and a smaller number of units when prices are higher, meaning a disciplined dollar cost averaging investor is, by the simple mechanics of the strategy, automatically buying somewhat more aggressively during downturns and somewhat less aggressively during periods of elevated prices, achieving a version of buy low, sell high behavior not through prediction or emotional discipline, but through pure automatic mathematical mechanics. The Canadian practical implementation: setting up an automatic recurring transfer from a bank account to a TFSA or RRSP, paired with an automatic recurring purchase of a diversified low-cost equity ETF such as XEQT or VFV on the same fixed schedule, is the complete practical implementation of everything covered in this video. This single setup decision, made once, calmly, outside of any specific market condition, converts the entire mathematical and behavioral argument of this video into an automated system that requires no further timing decisions whatsoever. The honest acknowledgement of what this strategy gives up and why that trade-off is favorable. Dollar cost averaging into a fixed schedule will, in any specific individual period in hindsight, sometimes produce a worse outcome than a hypothetical investor who had somehow correctly predicted the single best moment to invest a lump sum all at once. This is true and unavoidable. But because the data in segments 1 through 3 demonstrates that reliably making that correct prediction in advance, consistently, across an entire investing lifetime, has not been shown to be a dependable skill at the individual investor level. And because the cost of getting it wrong is asymmetric and severe, as shown in Segment 1, the small acknowledged cost of occasionally missing a theoretically better entry point is dramatically outweighed by the much larger, much more probable cost of behaviorally mistiming the market across an entire investing lifetime through the documented psychological patterns covered in Segment 3. Your action step. If you do not already have an automatic recurring contribution and purchase schedule set up for a diversified equity ETF inside a TFSA or RRSP, set one up today, specifically because today, in a calm, non-turbulent moment, is when this decision can be made free of the psychological pressures that make it so much harder to execute correctly during an actual future downturn. Let's come back to where we started. Missing just the single best 10 trading days out of literally thousands has historically cut long-run accumulated returns by roughly half or more, despite an investor having been invested for over 99.8% of all trading days. You now understand precisely why this is so dangerous and so easy to fall victim to, even with the best intentions and a genuine understanding of the underlying mathematics. The best days do not arrive during calm, comfortable periods when it feels safe to be invested. They cluster, with remarkable, well-documented consistency, in close proximity to the worst days, during the exact periods of maximum fear when an investor is most psychologically tempted to be sitting in cash. Recency bias and loss aversion, two deeply ingrained psychological mechanisms operating in essentially every investor to some degree, push individual decision-making in precisely the wrong direction at precisely the wrong moments, which is why decades of documented investor behavior data show the average individual investor capturing a meaningfully smaller return than the very market index they are invested in. The practical answer is not to develop superhuman emotional discipline or to become a more sophisticated market forecaster. It is to remove the decision entirely through a simple, automated, recurring contribution into a diversified, low-cost equity ETF inside a TFSA or RRSP, a system that, once set up in a calm moment, requires no further timing decisions, captures the mechanical benefit of buying more when prices fall, and structurally protects you from missing the small handful of days that, history shows, end up mattering more than all the rest combined. Time in the market does not beat timing the market because timing is impossible to ever get right by chance. It beats timing the market because reliably getting it right every single time across an entire investing lifetime has not been demonstrated to be a skill any individual investor can dependably rely on. And the cost of getting it wrong, even rarely, is too severe to risk.